Turning our attention now to the municipal bond market. Today, the largest Muni ETF fell to a 16-month low, dropping close to 2% on the day. In the meantime, yields on 10-year AAA munis have climbed to a 4-month high. Now, some analysts have been saying the sell-off in munis is a buying opportunity, but investors seem to be pulling money out. Last month, withdrawals from muni bond funds totaled $5.4 billion in just a 2-week span. Well, joining us now is John Miller. He's the Chief Investment Officer of Nuveen Asset Management, which has $76 billion under assets. Welcome to the show. Great to have you here in the studio. Well, you know, some analysts have been saying this is a good time to buy munis. They say the sell-off we've seen is more about supply and demand than about credit worthiness. What's your take on the situation right now?
I think it's difficult to pick the precise bottom, but I do think December is an opportunistic month. Opportunities are being created right now, even though this is a rocky month. The primary reasons for this are technical in nature. They're somewhat political and somewhat related to fund flows and supply. Let's
talk about the political nature of what's happening from a supply-demand issue. Build America bonds. This was a big component that really did help to raise tax-exempt bond prices, right? Many municipalities wound up issuing under the Build America bonds program because it was a little bit more advantageous to them. So we had less supply in the tax-exempt market. Now we're seeing that that's programs, it's not likely to be extended, and that's having a huge effect on these tax-exempt bond prices. But is it more than just that?
Oh, I think it is more than just that, although the Build America Bond program and the potential for it to come to an end at the end of this year is a huge component, because the Build America Bond program started back in March of 2009, and it has been a contributing factor because it expands the base of demand for municipals beyond upper income individuals domestically and into international investors, corporate bond funds, and so forth. So the uncertainty around Build America bonds, whether it gets extended or not, it is creating an exacerbated seasonal effect right now because it's pulling in a ton of supply in the month of December, creating some opportunities for investors.
Now let's talk about the opportunities specifically right now. I know that your fund actually does take position in what I guess I would call speculative grade or non-investment grade munis. Talk to us. We rarely hear about the high yield muni market because it almost feels like a contradiction in terms.
Sure. There is a significant component of municipal bonds which include lower rated and non-rated credits, BBB rated credits, BB rated credits.
And I think we have a graph here where we actually, this is your bond fund and your 1-year return there, but we actually have a graph that looks at the spread differential between AAA. Here we go. The spread differential between AAA munis and BBB munis. Now, how does this look to you? I mean, is this a fairly wide spread at the moment?
Yes, definitely. Credit spreads widen out dramatically during the year 2008, especially. And while there has been some narrowing during 2009, some narrowing earlier this year, these credit spreads that we reside in today's market are historically very wide, even though the default rates for BBB munis and lower rated munis have actually come down, and they've stayed very low historically, the probability of default.
And where in terms of maturities are you looking? I mean, you can really see the spread differential between BBBs and AAAs widen out as you move along the curve. Once you start to get it sort of in that 10-year to 20-year sector, it looks like it's quite wide.
Exactly, and that is the area where we're investing, and that is the area where there's a lot of supply of BBB, non-rated, and BB rated municipal paper.
Now, so we've had a lot of fixed income folks on the show, and we've talked a little bit about asset bubble pricing. People may be taking on too much risk right now in desperation for yield. How do you diversify your risk?
Well, conservative municipal bond investors will typically stay short, and they will stay high quality, and that has worked in the sense of anchoring prices in terms of lower volatility. So that is appropriate. Now, there has obviously been less and less yield available in the short-term high quality part of the curve. So extension along the yield curve gives you greater returns, greater potential returns, higher income, and lowering one's credit quality down into single A, BBB, and so forth, that also expands the income through wider credit spreads. But having said that, you're taking on more volatility. So it's just an additional return available for taking on some additional risk.
All right. Thank you so much, John, for joining us today. John Miller of Nuveen Asset Management.